Hey everyone, and welcome to This Explainer. Today we're taking a sweeping and honestly pretty cinematic journey straight into the very architecture of money. We're going to travel all the way from the visceral, emotional psychology of individual survival right up to the trillion-dollar, multi-generational empires that quietly steer the globe. It's a fascinating look at how capital actually moves, how it breathes, and most importantly, how it protects itself. So let's dive right in.
Because we really have to ask this fundamental question. What actually separates the people who are just barely scraping by from the dynasties that literally outlast entire nations? Today, we're going to look strictly at the evidence. We're stripping away all the myths to reveal the true underlying mechanics of extreme capital.
Let's start with part one, the psychology of wealth. To really get this, we have to understand the intimate, emotional reality of building from absolute scratch.
Now, for a lot of people, the starting point is a number exactly like this, $1,247. And you know, this isn't just a number. For a 23-year-old, this checking balance represents pure anxiety. At this stage, you're the person checking your bank app at 11:43 p.m. while sitting on a second-hand mattress. Every single grocery run is this heavy, stressful calculation. You put the good olive oil back on the shelf, you buy the store brand instead. Because at this level, money isn't a tool yet, it's just the air you breathe. And it feels like a mechanism purely for basic day-to-day survival.
But then, a really profound psychological shift happens when that balance finally hits 5 figures, $10,000. When you hit this in savings for the first time, that constant fear slowly begins to transform. You actually stop thinking about money as just a safety net, and you start seeing it as information. You start opening brokerage accounts. You're suddenly reading up on index funds. Your decisions begin to compound in the right direction, simply because you finally have the power of options. And as that wealth builds, you hit the next major milestone, crossing the $1 million mark. But believe it or not, this usually triggers a massive identity crisis. You suddenly realize that $1 million generating a safe 4% return is only $40,000 a year. It hits you that this isn't the finish line at all. It's literally just the starting point. The absolutely crucial shift here is the mindset. You stop obsessing over just accumulating cash, and you start using capital to acquire time, to build leverage, and to position yourself for the future.
Which brings us to our next chapter, the trap of crisis. If that's how individuals build wealth in times of calm, what happens when the calm completely breaks? Let's shift outward and look at how the average investor reacts to economic crises, because historically speaking, they react disastrously. Consider two neighbors who bought gold back in 2020. You've got Greg, an engineer, who bought at $1,780 an ounce right when the headlines were screaming about panic and inflation. To him, it felt obvious and safe. But his neighbor, Dan, bought 14 months earlier at $1,290, back when it was incredibly boring and literally no one was talking about it. By the time gold eventually slid back down, Greg, who made that late panic buy, lost $18,500. Dan, who bought early and strategically, locked in over $40,000 in profit. See, Greg was right about the economy, but he was completely wrong about the timing. And this perfectly illustrates the 150-year-old gold trap cycle. It happens with mechanical precision every single time. Smart money buys during the early warning phase when it's totally quiet. Then comes the panic spike, when retail investors jump in because it finally feels safe. But safety in markets is a consensus feeling, and it's almost always an illusion. Retail buyers get caught in the trap, unwittingly providing the exit liquidity for the smart money to cash out. And that's always followed by a multi-year slow bleed.
So naturally, part 3 is all about how smart money moves. Because if retail investors are the ones getting trapped, what exactly are the billionaires and the massive institutions doing? Let's step into the minds of the financial elite to see how they navigate these exact same crises.
The key to understanding this is this frankly staggering figure, $373 billion. That was Warren Buffett's unprecedented cash pile heading into 2025. Over 3 years, he quietly sold off massive equity positions, including huge chunks of Apple and Bank of America. And listen, this isn't panic. The smartest money in the room doesn't go on television and scream. They quietly, methodically build up cash and treasury bills. They demonstrate immense discipline while they wait for a major market dislocation.
And why are they preparing so heavily? Because the parallels to past crashes are honestly striking. Back in 2008, the system nearly collapsed not just because of bad mortgages, but because of extreme opacity. Nobody actually knew who held the risk. Today's senior central bankers are pointing directly at the $2.5 trillion private credit market.
It's grown tenfold since 2007, and it's characterized by the exact same leverage, complexity, and opacity that we saw right before the Great Financial Crisis.
So smart money is responding by rotating heavily. They're pulling out of crowded, expensive tech stocks, and they are pouring capital into physical infrastructure, commodities, real assets, and like we saw, holding massive cash reserves. They are waiting patiently for the cycle to turn, making sure their capital is protected in things that are tangible and real.
All right, let's pull back the lens for part 4, the rise of empires. To truly understand capital at its peak, we need to look at the sweeping history of extreme wealth. Because every single great fortune always begins with an era of ruthless consolidation and a desperate fight for survival.
Take the dramatic rise of the Nahyan dynasty in the harsh Arabian desert, for example. For centuries, they survived entirely on the pearl trade. But in the 1920s, the invention of Japanese cultured pearls absolutely crashed their economy overnight. It led to starvation, empty treasuries, and literal blood feuds between brothers. It wasn't until the first commercial oil exports in 1962 and the brilliant unified vision that created the UAE in 1971 that they transformed a barren desert into one of the wealthiest places on Earth.
The contrast in psychology during that transition is just fascinating. When the oil finally began to flow, Sheikh Shakbout hoarded the millions in iron chests inside his fort. He had lived through the trauma of the pearling crash, so his operating mindset was, wealth always vanishes, so he will never spend. It literally took his brother, Sheikh Zayed, orchestrating a bloodless coup to completely flip that script. Zayed took that wealth and used it to build schools, hospitals, and forge an entire modern nation.
Now, jump half a world away, and we see the exact same pattern of ruthless survival and consolidation with John D. Rockefeller. He started out as this highly disciplined clerk, keeping meticulous ledgers. But by 1872, he used secret railroad rebates to orchestrate what became known as the Cleveland Massacre, where he bought out 22 of his 26 competitors in just 6 weeks. By 1882, his Standard Oil Trust controlled a staggering 90% of American oil refining. He brought order to chaos, for sure, but he did it with absolute ruthlessness.
But here is the profound irony of extreme capital. In 1911, the U.S. Supreme Court finally dissolved the Standard Oil monopoly under antitrust laws. Everyone thought it was over for him, but breaking up the trust didn't ruin Rockefeller at all. It actually multiplied his wealth. He received shares in 34 leaner, highly profitable successor companies, which ultimately catapulted him into becoming the world's very first billionaire.
And once you build an empire of that scale, the game changes entirely. Let's transition to part 5, the final and grandest stage of capital, protecting generational wealth. This is all about the complex financial architectures specifically designed to shield unimaginable wealth from taxes, from time, and from ruin.
First up, we have the Sovereign Wealth Fund. Back in 1976, seeing the wild volatility of oil markets, Sheikh Zayed quietly created the Abu Dhabi Investment Authority. He took the surplus oil money and invested it across global markets. And that structure is exactly what insulated the UAE from future oil crashes. It's also what allowed Abu Dhabi to step in and bail out Dubai during the massive 2008 financial crisis. It is essentially the ultimate rainy day fund for a nation.
Then, on the private side, we have the Irrevocable Dynasty Trust. Going back to 1934, John D. Rockefeller set up these incredibly powerful legal structures. By locking assets away in trusts that literally skip generations, the fortune completely bypasses massive estate taxes. It legally shields the wealth from lawsuits and even from heirs who might want to spend it all. It is the architectural secret to why the Rockefeller family remains united and massively wealthy 7 generations later.
To really wrap your head around the scale of this preservation, just consider the numbers today. Abu Dhabi's sovereign wealth funds currently manage well over $1.5 trillion. They own physical infrastructure, aerospace companies, renewable energy grids, and global real estate. They have completely, successfully detached themselves from the vulnerability of relying on a single commodity.
So the crucial takeaway from all the evidence we've looked at today is crystal clear. Whether it's through a perpetual dynasty trust holding private wealth or a sovereign wealth fund protecting an entire nation, capital at the absolute highest level seeks one thing: immortality. Its ultimate goal is to operate flawlessly, compounding generation after generation, entirely without the daily presence of the people who originally built it.
Which leaves us with one final, deeply important question to consider today. Look at your own life right now. Is your financial position structured for the world the consensus assumes is safe? Or are you actively positioned for the world that the evidence and the quiet movements of the world's smartest money suggests is actually coming? Thank you so much for joining me on this explainer. Keep learning, keep positioning yourself, and I'll see you next time.